Our main presenter for our first session, Philippine bond market and project bonds for PPPs, is Dennis Montecillo, Executive Vice President of Bank of the Philippine Islands Group, Corporate Client Segment, and recently President of the Bank of the Philippine Islands Capital Corporation. Our four experts for the panel. First, we have Commissioner Ephyro Amatong of the Securities and Exchange Commission, Charles Anderson, Representative of the U.S. Department of the Treasury, Government Debt and Infrastructure Finance, Hock Khoo, Vice President for Operations of Credit Guarantee and Investment Facility, and Frederick Thomas, Senior Investment Specialist of the Asian Development Bank, Infrastructure Finance Division, Private Sector Operations Department. Dennis.
Good morning. This is really very cool. I thought I'd be speaking to 50 people this morning. This shows you how topical this is. You know, I often speak at conferences like this, and last month I did speak at a conference. And when I was invited to speak, it started out as a panel discussion. And in the course of our preparation, somehow or other, we were able to cajole the junior presenter to make a junior panelist to make a presentation, and the rest of us ended up taking pot shots at it. So, sorry, here we go, blah, 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 okay. Now, I'm a Christian, but if I were a Buddhist, I would think that this is really karma, because that junior presenter ended up putting up slides that we all took pot shots at. So I guess my first, not only that, I've experienced a very distinguished panel of experts, as you mentioned. So I'm just going to ask my four panelists to be kind to me this morning. I see my job this morning as setting the stage for a discussion, because really all of the other sessions can be thought of as being connected into one long session, where we're looking to answer the question of how we in this room can help make all of these priority projects happen. The fact that there are, I guess, over 200 of us in this room today leads me to believe that we think we can help, that we see not only commercial opportunity, but the national priority and urgency of what we need to do. So, if I can have this thing to work. Okay, here's what I'd like to talk about today. The situation, the opportunity, the evidence, the issues, the buy-in, and the imperative, all in 11 minutes. Okay, so let's imagine a two-dimensional world for a moment, where we have project size on the y-axis and project life cycle on the x-axis. Some of this is blindingly obviously, but I just want to set the tone here. We already have a relatively active galaxy of participants in the project, in the pre-project level. You have banks, you have some institutional investors, certainly private investors, other QIPs, and to some extent retail. A lot of this, of course, happens in some respects below the radar screen, because many of this happens in the corporate world. Because you'll see that this happens in the form of senior loans, it happens in the form of corporate notes, and it also happens in the form of corporate bonds. After all, if you really look through it, a lot of the project sponsors today are the well-known conglomerates who are household names. In effect, they borrow money at the holdco level and inject that as equity at the project level. So, in some respects, the investment market or the investor market is already quite familiar with project bonds, but in a very indirect way. Foreign investors are just now starting to come in. BPI Capital co-sponsored a bond survey last year, and I think we got feedback that about 36 or 37% of our investors are interested in or intend to invest in project bonds, such as they may be structured. It starts to get more interesting as we get into the construction and takeout process, and more and more banks are participating in that particular area. And of course, we have the help from our ECA and multilateral friends. to make this happen. Here we go. What we try to do here is really try to demonstrate, or at least show, that we're starting to see foreign participation as well now in this particular phase. Some of this is aspirational, some of this is real. I would say it's mostly aspirational. And really part of the reason why we're gathering here today, I see many of my foreign friends here and others who I haven't met, who I'm guessing are also from foreign institutions. And I think this is very exciting because there really is quite a bit of room and a lot of opportunity. And really, that's really what we're aspiring to in the end, what we're calling project bonds. Although in the end, I think we can expand or narrow that definition as much as we like. I should also point out, just to make, not to make too fine a point on this, about investors being comfortable, you'll see that in the corporate bond market, one of the most popular sectors or subsector of issuers really are those who are quite active in the let's call it the project finance market. You know, household names like Securities, which had a very successful bond last year. I wonder which bank did that one. As well as Ayala and many of the other corporate names. And we're also, okay, so let's talk about the opportunity. Clearly, as demonstrated by all those projects that are in the pipeline, there's already a large demand for capital. Some of the other numbers that I picked up here just from the public domain, currently the 11 projects total about 284 billion pesos. There's another 527 billion awaiting net approval. Energy requirements over 12,000 megawatts over the next 15 years, requiring 1.2 trillion pesos of capital. In the midst of all of this, of course, we have other constraints or other issues that we need to take into account at the bank level. As much as many of the banks would love to finance this, we're finding, of course, other competing interests because our very own governor has already as much as said, okay, Mr. Banker, this is terrific, you can give us all, you can finance this as much as you like, but guess what? This is probably not going to happen. So in some ways, some of us are being brought kicking and screaming into this room, realizing that the only other way we can participate in this is through the bond market. And in some ways, I suppose that's true. The governor is he's doing a terrific job, and of course, his job is a little bit different from ours. His job is to watch over the banking sector. So, you know, despite the fact that we're being pulled kicking and screaming into this room, here we are. And so now it's incumbent upon our other friends in government to help us by, in a sense, expediting, facilitating, assisting us in getting the job done. On the other hand, as you know, there is quite a bit of liquidity in the institutional market. I'm not even sure I'll bore you with some of the numbers here. Well, maybe I will. 2.6 trillion from private pension funds, insurance companies 863 billion, from our very own GSIS 454 billion, SSS 324 billion. So what's the punchline? There's a lot of money out there. What we need to do as bankers is connect capital with ideas, just to borrow a corny phrase from my former employer. Really, that's the opportunity in front of us today. Let's hope Mr. Murphy doesn't end this presentation for me because this thing's backed up. All right, so what is the evidence that this can be done? Well, a long time ago in this particular galaxy, some of you may not even have been born then, we actually had a couple of project bonds that were done. Forget for the moment that one of them was from an issuer that no longer exists and was in the papers for a long time. I think really the point of this slide, and I'm not going to belabor this by going into details, is really to suggest to everybody in the room that this has been done before. It's been done in slightly different circumstances, perhaps slightly different structures. But look, we're not having to reinvent the wheel here. This has been done in the Philippines already in the past. Of course, there are common themes in this particular case because it was a different time. This was backed by solid contracts with the national government in some form or another. And also I would point out, and I'd be very interested in hearing from our government counterparts here, the kind of the flip side of all of this, because some of these perhaps were fast-tracked and got done quickly. You see a little bit of the ripple effects now because some of the public proponents would argue that we ended up doing deals at levels that were disadvantageous to the public at large. So there's always this tension between getting a job done, getting a deal done, but at the same time, some of the unintended consequences of fast-tracking these projects. A little bit closer to our time zone, but in another galaxy, you'll see Latin America more recently having come up with deals of its own. And again, I'm not going to go into much detail here, but simply I put this up to suggest to you that there have been deals that have been done of late in other parts of the world. In many cases, they had similar characteristics to the Philippine deals that were done in the 1990s. Solid and long-term take-or-pay contracts with built-in FX cost pass-throughs. They were backed in some form or another, or they were operating assets in other cases. There were also credit enhancement features incorporated into it, and they've got the hook out. They're trying to kick me out now, so I'm going to talk much more quickly here. But really, again, the point is there are precedents here. We don't need to reinvent the wheel. Many issues abound in terms of what we need to do here. Some of them are patently obvious. We have the greenfield versus brownfield issue. Certainty of execution is an issue both from the issuer side as well as the execution side. On the issuer side, you have the staggered requirements of payments vis-a-vis the one-time drawdown of a bond. And on the part of the investor, who is much more accustomed to credit risk, underwriting project finance risk is a very different animal. I know, having been on that side, what a challenge it is to convince investment committees to take a look at these kinds of risks. There are other structuring issues, of course, that we need to look into, such as the due diligence issues that typically we run into. Let's face it, project finance is a hard product by any stretch of the imagination. Tenor is becoming less of an issue these days. I think it has much more to do with the amortizing nature of the bonds that's difficult, not just for investors, but frankly, even as it has to do now with our current bond exchange. The uneven payments or sculpted payments tend to be much more difficult to deal with. Why do we need to do this? Investors, of course, we think that these are good deals on a risk-adjusted basis. We think that if understood properly from both the investor and issuer side, these types of risks can offer a yield premium. And for those yield-hungry investors out there, if we can show you deals that do provide that, and we can convince our issuer clients that they do need to pay these premiums because of these structures, we think that there's scope for a meeting of the minds. For issuers, of course, investor base broadening is a real issue these days because of the whole SBL constraint. At our bank, we've been able to convince our own stakeholders that this is no longer a zero-sum game, where project bonds used to be looked at as taking capital away or taking opportunity away from those corporate lenders who wanted to load up on credit risk with their proponents. They're seeing this now as not an either or, but a both and. So what are we going to need to do to make this work? The short answer, of course, is we all need to work together. There are four major constituencies that we can see here, of course. For project sponsors, they're going to need to better understand, or at least we need to convince them to think about this as a recycling of bank lines. The third point here I want to spend a little bit of time on, really, when you think about it, what many of these holdcos are doing is they're borrowing from the public markets and they're injecting equity into these projects, which is good up to a point. But I would argue that as these projects get bigger and bigger, there's inherent risk in that particular strategy, because effectively you're arbitraging the bond market or the corporate bond market with the equity market, and that works in good times but doesn't work in bad times. On the other hand, for those of you who are in the private equity side of all of this, some of you have already, I think, seen the light here, but many of the people who I talk to private equity, because this used to be my former world, just don't get it in terms of the risk-adjusted return levels they're going to need to take into account. You can't get 20% IRRs on base cases with project finance, and that's just the reality of it. So if you want to come here and play, you want to invest big amounts of money, look at buying down the risk rather than enhancing your returns. Also talk to your friendly bankers to know what they're talking about. For investors, for the debt investor side, I would say, again, I look at this challenge for investment committees, particularly those who have investment committees that are not here in Asia. I know that it's a major challenge to convince them. You know, first of all, you need to educate them about the Philippines. It's 2 Ps, not 1. It's 1 L, not 2. So you start with that, get them accustomed to that. But we here in Manila are trying to do whatever we can to make it easier for you, and the government's done a great job already in doing that by really making this a national priority. And our friendly multilaterals, of course, are already helping us and can help us some more. Everybody's got requirements. They've got documentary requirements, and we're all doing our best to try to fill that. So we need to try to narrow the gap between what's reality here in terms of what can get done in the domestic market and what your own principles, wherever they may be based, are requiring. Sorry, most important, let me see if I can back this up. Government. For our government friends, I think you're doing a terrific job already. A little bit more coordination might be nice. Certainly would be helpful. If one of the agencies is going to make it hard for us, maybe the other agency can make it a little bit easier for us. Sorry, since you're going to take a swing at me anyway, I might as well point that out. So some coordination would be nice. And support, and not just support. I think I had a conversation with Charles Anderson today, and I think that one of the other issues we need to think about is all of us over the age of, all of us over a certain age are so accustomed to the Philippines being in survival mode, right? All of us went through, some of us went through martial law, some of us went through bank restructuring, the Paris Club, et cetera, and we all survived that. Well, guess what? This is now a different time, and those hard times may come back. But I think we need more fresh thinking nowadays in order to think about how we can structure past some of these hurdles. Sure, there's downside, but now there's upside. Okay, the hook's going to come out very soon because I'm getting the red light here. Okay, final point. 4 points I'll leave you with. Number 1, there's nothing new under the sun. There are lots of best practices out there. And we don't need to reinvent the wheel here. There are lots of bond deals that have been done out there that we can adapt our local requirements. Number 2, this is not an either-or situation. It's a both-and situation. Not just the proponents around this room, but everybody else. We need to work together to make this happen. Number 3, just because it's hard to do doesn't mean we shouldn't do it. Because we either need to break through this barrier or jump higher. Because after all, this is a national priority. This absolutely needs to get done. So I'll end there and ask my colleagues to start swinging. Thank you very much.